Hello friends, I welcome you to the next lecture on Indas 10 Appendix A. So we are going to discuss Indas 10 Appendix A, which corresponds to IFRIC 17. We are going to discuss about distribution of non-cash assets to owners. Okay. So before I go into this, see, Indas 1, presentation of financial statements only provides that when you declare dividends after the reporting period, the dividend should not be adjusted in your books of account. That means you are not going to provide for the liability, you are not going to subtract it from equity, and you are not going to show it as a liability. That is what the standard says. So when you declare dividends after balance sheet date, they are not adjusted in books of account. But how to measure that dividend? Whenever you declare dividend or whenever you pay dividend, if you pay dividend during the year, you can adjust it from your books of account. You can adjust it from equity and you can show it as a liability. But how to measure that dividend is not provided anywhere in any of the standards. So this appendix is dedicated to a particular issue. If suppose company wants to declare dividends, it wants to pay dividends not in the form of cash, it wants to pay dividends in the form of non-cash assets to its owners. Owners are equity shareholders. So how do you deal with those dividends? Dividends relating to non-cash assets. That means dividend is going to be distributed in the form of non-cash assets. So how do you deal with it in your books of account? If the dividend is declared during the year, if the dividend is declared after reporting date, that is after balance sheet date but before approval of accounts by the board of directors, how do you deal with these kind of dividend is what we are going to discuss in this appendix. Okay, so let us go ahead now. So applicability, this appendix is applicable only to non-reciprocal distributions. That means the entity, the business entity is going to distribute its non-cash assets or sometimes even cash to its shareholders, and it is not going to receive anything from the shareholders in return. That is called as non-reciprocal distributions of assets by an entity to its owners during the year or after balance sheet date. So during the year, if the company has declared some dividends in the form of non-cash assets, or after balance sheet date but before approval of accounts, if such dividends have been declared, how do you deal with it is given by this standard. Okay, so this standard applies to two specific situations. One is distribution of non-cash assets. Which kind of non-cash assets we can distribute as dividends? PPE, property, plant and equipment, can be distributed. Sometimes a business, the company has various businesses, one of the businesses being distributed as dividends to its shareholders, owners, ownership interest in other entities. Our company has shares in other companies, those shares are distributed in the form of dividends to our shareholders. Disposal group, see, an entity is having a group of assets which it is holding for the purpose of disposal in the near future, and this group has been called as a disposal group under Indas 105. That disposal group, that is a group of asset or liabilities, can be even distributed as dividends to its shareholders. Apart from that, even stocks, company has some stock, inventory can also be distributed as dividends to the shareholders. So this appendix applies to distribution of non-cash assets. It also applies to a situation where distribution in which gives the owners a choice to either take non-cash assets or cash. That means the company can declare dividend and you can give a choice to the shareholder, saying that you can either receive shares or you can receive shares, you can receive assets, or you may receive cash. So that means you can give a choice to the shareholder, saying that you may either decide to take cash as dividend or non-cash assets. So this standard is going to apply to both the situations. Okay, let us continue. Issues addressed. Three major issues are addressed by the standard. The first issue is, when should I recognize dividend payable as a liability in my books of account? When? That is a date on which I can book dividend payable as a liability and subtract it from equity. When? The second question is, how to measure that liability? How much dividend am I declaring? How much should I recognize as a subtraction from equity and show it as liability, dividend payable? So how much? How to measure that amount is what we are going to discuss in the standard. Third, when the dividend is settled, there is a difference between the carrying amount of the dividend liability and the carrying amount of the asset, the book value of the asset and the book value of the liability. If there is any difference between the book value of the liability and the book value of the asset, how do you deal with that difference is also what we are going to discuss in this particular standard. So these are the three major questions which are going to be discussed by this standard. Let us go to the first question. When should dividend payable be recognized? See, for companies in India, in the case of final dividends, the board of directors will propose the dividend and it is declared by the shareholders in the annual general meeting. That means in the case of final dividend for companies where approval from shareholders is required, so the date on which the shareholders approval has been received, on that date we are going to recognize dividend payable. But if the law does not require any approval from the shareholders, the day on which the management has declared the dividend, on that date we are going to recognize the liability. So we can break it up into two situations where approval from shareholders is required, where no approval is required. Where no approval is required, the date on which the board has declared, that is the date on which you have to recognize the dividend. If approval of shareholders is also required, the date on which the shareholders have approved the dividend, on that date we are going to book liability in our books of account, reduce it from equity. So this is the answer to the question, when should I recognize dividend as a liability in my books of account? So we now come to the next question, measurement of dividend payable. So how do you measure the amount of dividend which is payable? So what the standard says is, if you are paying dividend only in the form of non-cash assets, the prescription of the appendix is the liability will be equal to the fair value of the asset which is going to be declared as dividend. So the day on which you have declared the dividend, on that date whatever is the fair value of the non-cash asset which you are going to declare as dividend, that is equal to the liability. Okay. But suppose if you have given a choice, the shareholder can either claim cash or he can claim in the form of non-cash assets. In such cases we have to find out, we have to use a simple formula, fair value of the cash option multiplied by probability, fair value of the asset option multiplied by probability. So you have to take the sum of both of them and then you will arrive at the liability. So we have to find out how many shareholders are going to go for cash option. So under cash option, how much cash am I going to give, how many shareholders are going to claim. You have to keep these factors into mind. Then you have to also estimate how many shareholders are going to go for the non-cash option and what is the amount of liability if they go for the non-cash option. You have to consider both the facts for arriving at the total liability. So this is what the prescription of the standard is. Let us go ahead. Next, when no choice is given, I have an example here. DF Limited manufactures smartphones. On 1st March 2016 declares dividend to distribute one phone to each of its 100 shareholders. So the company has only 100 shareholders. All shareholders, let us say, are equal. So every shareholder is going to get one phone as dividend. That is what the company has decided. The fair value of each smartphone is 10,000 rupees. On 31st March 2006 it is approved by the shareholders. So on 31st March 2016 shareholders have approved this dividend, and on that date the fair value of the phone is, let us say, 10,000 rupees. Now I am going to pass the entry. On the date of approval I have to pass this entry, equity account debtor to dividend payable. There are 100 shareholders, each shareholder is going to get one phone into fair value of each phone 10,000. So the liability will be 10 lakh, it will be subtracted from equity and it will be shown as a current liability under dividend payable. Okay, so this is how you deal with when no choice is given. Okay. Now let us see an example where choice is given. DF Limited is into manufacturing, it's a manufacturing company. It decided to declare a dividend on 1st January 2016 to its existing 2000 shareholders. Each shareholder can either receive 100 rupees cash or 4 shares of XYZ Limited. So the company is giving a choice. Either you can take, each shareholder will either get 100 rupees cash or he is going to get 4 shares in XYZ Limited. Okay. So this is the choice given by the company. The management estimates that 60% of the shareholders will take cash. That means 60% of them feel it is better we go for cash. So 60% of them are going to claim that 100 rupees per shareholder as cash. But the remaining 40% will go for the share option. And the remaining will opt for shareholders, for shares. Fair value of each share on 1/1/2016, that is the date on declaration of the dividend, is 20 rupees per share. So now we have to arrive at the estimated liability. So let us see how we arrive at the estimated liability. You can see the calculation here, estimation of liability, fair value of the cash option. Out of 2000 shareholders, 60% are going to go for cash. That means 1200 shareholders, each shareholder is going to get 100 rupees. 1,20,000 is what we have to pay in cash. Then fair value of the share option, 2000 shareholders, 40% of them are going to go for the shares. Each one of them, that is 800 shareholders, each one of them is going to get 4 shares in XYZ Limited, and the fair value of each share on the date of declaration of dividend is 20, so it comes to 64,000. So total liability will be 1,84,000. We will pass an entry, equity account debtor to dividend payable 1,84,000 rupees. See, here we are considering the fair value of the share. Book value of the share may not be equal to 20. The book value of the share may be lower than 20 or more than 20 also. But we have to consider the fair value of the share on the date of declaration of dividend. So this is the entry we are going to pass on the date of declaration of the dividend. Next, we come to the next issue, remeasurement of liability. See, if there is a situation where the dividend is declared during the year, it is unpaid by the end of the year, then how are you going to remeasure the liability? This is what we are going to discuss now. So during the year you have declared dividend, you have already recognized the dividend, but by the reporting date, that means by the balance sheet date, the dividend has not been paid. So should I review? The standard says yes. So at each reporting date and on settlement date, you have to review the liability amount. If required, you have to either increase the liability amount or decrease the liability amount. liability amount will increase if the fair value of the non-cash asset which you are going to distribute as dividend has increased. See, the liability depends upon the asset. If the asset value increases, then liability also increases. If the asset value reduces, then the liability reduces. So you have to review and remeasure the liability at each reporting date and on the settlement date as well. And if there is any difference between the current liability amount and the remeasured amount, it has to be adjusted straight away in equity. It is not going to be shown in profit and loss account. So if the liability increases, show the impact in equity. If the liability reduces, show the impact in equity. Don't show it in the profit and loss account. But on each reporting date, if the dividend has not been settled at each reporting date and on the date of settlement, you have to remeasure and adjust the liability amount. That is what the standard says. And any adjustment has to be shown only in equity, not in the profit and loss account. Next, accounting for difference between carrying amount of dividend payable and carrying amount of the asset. On the date of settlement, if there is any difference between the book value of the liability and the book value of the asset which is being used to settle that liability, the difference should be recognized in profit and loss account. You will be able to understand these prescriptions when we see an illustration. In the next slide, we are going to see an illustration how to deal with it. So we can see here example 2, review adjustment of carrying amount of liability. Same example, DF limited example, where a choice was given to the shareholders is taken here. On 31st March 2016, fair value of each share of XYZ Limited increased to 25. So if you remember, on 1st March, the fair value of each share was only 20. On 31st March, that is on the reporting date, the liability has still remained unpaid, and now the fair value of each share has increased to 25 rupees per share. So automatically shareholders will feel now that the share option is more lucrative than the cash option. That means now more shareholders may think about taking the share option rather than for the cash option. Okay. So probability of the cash and share option is 50-50 on 31st March. So company is now re-estimating the number of shareholders who are going to take cash and number of shareholders who are going to go for the share option. So now they have assumed that it is going to be now 50-50. So management has estimated it. So fair value of the cash option, 2000 shareholders, 50% of them will go for cash, 100 rupees, 1 lakh. And remaining fair value of the share option, 2000 shareholders, 50% will go for shares. Each one will get 4 shares. Fair value of each share is 25. So it will be 1 lakh. So total liability is 2 lakhs. So on reporting date, let us assume the liability has not been settled. Now we have to increase the liability amount in our books of account. Earlier liability which was recognized in my books was 1,64,000. Now I have to increase it to 2 lakh. I will pass an entry, equity account or dividend payable. That means I am debiting equity and I am crediting dividend payable 36,000 rupees. So I have to increase the liability, and the effect is not shown in P&L account, the effect is shown in equity. Now let us continue. On 1st June 2016, settlement date. Let us take that the company is paying the dividend actually on 1st June. What is happening on that date? Settlement date, fair value of each share of XYZ Limited decreased to 15 rupees per share. On reporting date, the fair value of the share of XYZ Limited increased to 25. Now it has reduced to 15 rupees on the date of settlement. Now only 75% of the shareholders opted for cash payment. So now people feel that it is better I go for cash rather than go and take the shares, because it is fluctuating a lot. So now we have to again re-estimate the liability on the date of settlement. Fair value of the cash option, 2000 shareholders, 75%, 100 rupees, 1,50,000. Fair value of the share option, 2000 shareholders, 25%, 4 shares, they are going to get 15 rupees, 30,000. So now the total liability is only 1,80,000. Earlier we had increased the liability from 1,64,000 to 2 lakh. Now we have to reduce the liability from 2 lakh to 1,80,000. That means we have to give back some amount to equity. So we will reverse the entry, dividend payable account data 20,000 to equity account 20,000. So this is the entry we have to pass to reduce the amount of dividend payable which is already recognized in our books of account. Okay. So this is the entry I passed first to adjust the liability. Now once I have adjusted the liability, from 2 lakh it has reduced to 180 now. I now know that out of 180, 150 is to be paid in the form of cash and 30,000 has to be paid in the form of shares. So how do I pass the settlement entry? Let's go ahead. Settlement entry. Dividend payable account or to cash, this is the cash portion, and then the remaining 30,000. The carrying amount of the shares was only 20,000. So the shares which we are going to settle, the remaining 30,000 of the liability in our books is appearing at only 20,000. So dividend payable account data 30,000. This is the carrying amount of the balance liability. 2 shares in D Limited 20,000. Now I am giving away the shares. I have to de-recognize the shares from my books. Hence I am crediting the shares account here. The difference has to be credited to profit and loss account. So this is what the standard has to say. Okay. So the difference 30,000 minus 20,000. This is the liability which was settled, carrying amount of the liability which was settled. This is the carrying amount of the asset which was used for settlement of the liability. It is recognized in profit and loss account as required by Ind AS. Okay. Now let us come to the disclosures required by the standard. Carrying amount of the dividend payable at the beginning and at the end of the reporting period. Suppose it's a very rare circumstance, the law may not permit it, but the standard says if any dividend has remained unpaid at the beginning of the year, at the end of the year, you have to disclose those amounts. Increase or decrease in liability recognized in equity during the year if the dividend liability has increased. How much it has increased during the year if the liability has reduced. How much it has reduced by, it has to be disclosed in notes to account. If dividend is declared after balance sheet date. So the dividend is declared after balance sheet date but before approval of account, some disclosures are required. Nature of the asset to be distributed. So what is the asset you are going to distribute? Is it property, plant and equipment? Is it business? Is it shares? Is it stock? Which asset are you going to distribute as dividend has to be disclosed. Carrying amount, that is book value on the balance sheet date, and also the fair value has to be disclosed. Not only the fair value, see, whenever we say fair value of the asset, we talk about determination of fair value under Ind AS 113. So how to determine fair value of an asset? Specific prescriptions are contained in Ind AS 113. So we have to disclose not only the fair value based on Ind AS 113, we also have to disclose the methods or the level of input which you have used under Ind AS 113 for the purpose of determining the fair value of the asset. So this has to be disclosed. Inapplicability. Now this appendix does not apply to certain situations. What are those situations? If distribution of the asset is not done equally to shareholders of a particular class. So within a particular class of shareholders, if you are not distributing dividends equally or proportionately, if there is a partiality going on, then this appendix is not going to apply. Next, if the asset is controlled by same group after distribution, a business which was run by a company was controlled by a group of people before distribution, and after distribution also it is being controlled by the same group of people, then in such cases it is covered by Ind AS 103, it is not going to be covered by this standard. So if an asset was controlled by a group of individuals before distribution and after distribution the same people are going to control the asset, in such cases this standard is not going to apply. Next, this specific requirement is there under Ind AS 103, you will learn how to deal with it there. If the parent distributes its shareholding in a subsidiary without losing control, a parent has shares in subsidiary. Let us say it has 100% shareholding in subsidiary. 10% of the shares in subsidiary it is distributing as dividends to its shareholders. So what will happen is, because of this, the control of the parent in the subsidiary will reduce from 100 to 90. How to deal with reduction in control of a subsidiary? Reduction in shareholding in subsidiary is covered by specific standards. Ind AS 110 will talk about how to deal with consolidation, how to deal with reduction in the percentage of shareholding in a subsidiary. A separate standard is there. This standard is not going to apply. What the company is going to do is, company is going to recognize minority interest in its place now. Okay. So when a parent distributes its shareholding in a subsidiary to its shareholder in the form of dividends, this standard is not going to deal with how to do the accounting for it. Okay. The next and the last thing is, accounting in the hands of shareholders is not covered. That means if a shareholder is receiving any non-cash assets as dividend, so how do you deal with it in his books of account is not covered by the standard. So we are only talking about accounting in the books of the entity. Okay. So this is what the standard has to say. Before I finish the lecture, the only 2 points are, if dividends are declared during the year, they can be accounted, they can be adjusted in our books of account. That means you can reduce it from equity and you can show it as a current liability. If dividends are declared after balance sheet date but before approval of account, it cannot be adjusted in our books of account. That means you cannot reduce it from equity and show it as a liability. It has to appear only in the form of notes to accounts. Okay. And what disclosures are required, we have already discussed this in the particular presentation. Thanks a lot.